Sri Vasudev Murthy Garu, respected Speaker of the Day, Sri PVSS Prasad Garu, senior members in the profession who signed in virtually, ladies and gentlemen who assembled virtually, good evening to all of you. On behalf of the managing committees of Visakhapatnam branch of SIRC of ICAI and managing committee of Visakha Tax Bar Association, I take this opportunity to welcome you all to this virtual meeting on clause by clause analysis of direct tax proposals in Union Budget 2022. This is Madam Sitharaman's fourth budget. As you are all aware, the 2021 budget is the longest speech budget, which lasted for 2 hours 42 minutes. At the end, she has become unwell and she could not complete in toto. The last 2 pages were also left out, and she requested the speaker sir to deem it as read. This fourth budget is the shortest budget speech, which is the shortest budget speech of hers, which clocked at 90 minutes. As you are all aware, in the month of January, we will all proceed with a big wish list to FM, corporates, unions, associations, whoever it is, and they will try to impress upon and wish to have many of their favors. Impressing everyone is literally not possible. So after 1 year or after some time, with the performance of the budget only, we'll be knowing how the budget is ranked. In the Indian economy, about 7 budgets are named as iconic budgets. They are called so for various reasons and different reasons. For example, the black budget, 73-74 budget presented by FM Yashwantrao was called black budget, as the fiscal deficit during that year was about 550 crores. Carrot and stick budget, 1986 budget presented by VP Singh, was the first step towards dismantling the license Raj in India. It was called carrot stick budget. It offered both rewards and punishments. It introduced MODVAT and launched an intensive drive against smugglers, black marketers, and tax evaders. Epochal budget, Manmohan Singh's landmark budget in 1991, ended license Raj and began the era of economic liberalization. Dream budget, very popular, Chidambaram's 97-98 budget, which used Laffer curve principle to lower tax rates to increase collections. Tax reforms like VDS were also introduced. Then comes Millennium Budget, Yashwant Sinha's Millennium Budget in 2000, which has laid a roadmap for the growth of India's information technology. Rollback Budget, Yashwant Sinha's 2002-03 budget, popularly remembered as rollback because several proposals in it were withdrawn or rolled back. Then once in a century budget, Madam Nirmala Sitharaman's 21 budget is called as once in century budget, as it aimed to revive the Indian economy by investing in infrastructure and healthcare while relying on an aggressive privatization strategy and robust tax collections. Members, how this budget does and what it will be named in future days, only future will be deciding. This budget 2022 focused on infrastructure, digitalization and technology, and on sectors like health, education, and provision of e-services to the masses. We are observing the Azadi Ka Amrit Mahotsav, which is an initiative of the Government of India to celebrate and commemorate 75 years of Indian independence. And this budget is also proposed to be the blueprint for the Amrit Kal, roadmap for the next 25 years, India development at 100 years. Some economists opined this budget does not play to the gallery. This budget, under the favorable conditions, they opined will result in great report card at the end of financial year 23. On the other hand, some were unmoved by the budget, some were disappointed, some were dissatisfied. Likewise, it went on. However, we professionals shouldn't expect or encourage instant gratification from every budget, as instant gratification is like fast food, harmful and addictive. As the saying goes, the road to success is always uphill, and we need to practice patience to see the fruits of any vision. Friends, to analyze this budget, we have with us our regular speaker, Sri PVSS Prasad Garu, who is presenting it for the 7th time. He is the regular presenter to analyze the budget in Hyderabad branch as well as in Visakhapatnam branch. He is not a new face in two Vizagates. He has participated in many seminars, but for the benefit of the newcomers, I wish to present a very condensed profile of Sri Prasad Garu. Sri PVSS Prasad is senior partner of Prasad and Prasad Chartered Accountants, Hyderabad. He is in practice for more than 35 years. He has held various prestigious positions during his career. He is past chairman of Hyderabad branch, past president of the AP Tax Bar Association, past president of All India Federation of Tax Practitioners South Zone, past chairman of International Physical Association Hyderabad subchapter, past member of the executive committee of the International Physical Association, vice chairman, past vice chairman of IFA India branch in 2018-20. Twice he was co-opted member of committee of International Committee of ICAI. He was appointed as one of the branch reporters for IFA Congress that was held at Rome, Italy, on the subject tax treaties and tax avoidance application of anti-avoidance provisions. He was invited to speak at IFA Asia and Africa conference held in Mauritius thrice. He was invited as a panelist at Asia Pacific Regional Conference 2016 held in South Korea. He co-authored a book titled International Taxation, a Basic Study. Sirs, with this few words of introduction, I take the honor in presenting to you all the speaker of the day, Sri PVSS Prasad, who deciphers the direct tax proposals in Union Budget 2022. Sir, over to you and for your views.
So thank you very much, my beloved friend Chilangaru and other, office bearers. Am I audible?
Yes, sir.
Yes, sir. Yes, sir.
Yes, sir, you are audible.
Vice Chairman of the Visakhapatnam branch, Mr. Vasudev Murthy, and of course, Mr. Murali Krishna, Chairman, is also as logged in as I could observe from the screen, and my good friend Mr. Kam Shastri and other good friends from Visakhapatnam. It's my pleasure always to be back once the budget is presented. It's a great hectic learning process, just trying to know what is in store for us in the future, and what amendments have been taken up and how they are going to impact us, whether these amendments are really justified, whether there is any scope for any post-budget memorandum. All this is a very hectic exercise we do very religiously on a timely basis once the budget is presented. So anyhow, we are at the threshold of an economy which is rebound. A heartening news, in fact, of severe pandemic. First, second, and third wave. The second wave has been very deadly. And in spite of all this, the Indian economy is very resilient and rebound with an estimated growth figure of 9.2% as mentioned by the Honorable Finance Minister in her speech for the current year. That's a very heartening news. And at the same time, the latest month's GST collections have been a whopping maximum collection figure in the recent past. And we are in the process of introducing digital rupee because you have been hearing about cryptocurrency doing rounds in the markets from the last 1.5 years. So the government has readily announced that there would be a digital rupee in the coming financial year, which would be released officially by the Reserve Bank of India. And we have achieved one of the most difficult PSU disinvestments in the case of Air India. Of course, Air India getting back to Tata's group. This is a real great heartening news because Air India has been, incurring huge losses from years and years. And it's the right move by the government to disinvest Air India. So friends, let us just quickly go through the clauses to the extent possible in the limited time available. Wherever it is required, we'll be having a detailed discussion because some provisions are quite interesting. Some amendments are quite interesting and we need to have a detailed discussion. So there are no changes in the personal tax rates of individuals, HUF, AOP and all that. Let me, share the screen first of all. 1 minute. My presentation, I will just. So as far as tax rates and slabs are concerned, there are no changes as far as individuals, HUF, AOP, BOI and all that. The alternate minimum tax, which is in line with the minimum alternate tax for corporates, we have it for cooperative societies also. There, the government has taken a view that it should be lowered to 15% on par with the corporates as of now. And surcharge for cooperative societies, especially the cooperative society, credit societies and banks are going to benefit. The surcharge has been reduced from 12% to 7%. And the rate of surcharge even for the association of persons consisting only companies as its members is capped at 15%. This is a very important thing which we need to observe. As you know, the large infrastructure projects are handled by consortium of companies in the form of association of persons. As you know, one of the companies gets a huge infra project from the government and it would take the help of the other corporates, form into a consortium, and the consortium will deliver the execution of the project. And this AOP taxation is very, very critical, wherein we have the different rates of surcharge. Now it has been capped at 15%, which is really going to help this particular industry infra projects and the related companies coming into consortium. And the long-term capital gain and short-term capital gain with reference to unlisted securities, we have again the whole host of surcharge rates starting from the lower level to the highest rate of 37%. Now again, which is now capped at 15%, which is a very heartening news because that is brought in par with the equity funds and mutual funds and the listed company shares, which is a welcome proposition. And coming to the trusts and charitable institutions, of course, the whole idea of tinkering with these two exemption regimes, that is 1023C and section 11 and 12 regime, the whole idea is to ensure there is an effective monitoring in implementing these provisions and ensure that there is no abuse of these provisions and bring consistency in the provisions of the said two exemption regimes, providing clarity on taxation in certain circumstances. Of course, one thing I can broadly tell you here is the two exemption regimes are being tightened beyond the requirement proportion. Always there has been a sort of tinkering with these provisions time and again, if not regularly in every budget. We keep seeing this once in 2 years, once in 3 years. In spite of having settled law, sometimes this tinkering will really undo many settled propositions. And now, when the other day we had a All India IFA panel discussion, India branch panel discussion, wherein Kamlesh Varshni, the senior IRS officer who spearheaded advanced pricing agreement scheme in a big way some 15 years back, and now he is in the policy making body of the government as a joint secretary. And he was invited as one of the panelists. And when he was asked by the moderator, Arun Giri from Tax Sutra, Kamlesh Varshni mentioned, Arun asked him what are the two most important amendments proposed in this finance bill. Then he readily talked about this trusts and charitable institutions and updated return, which we will discuss a little later. So whether this tinkering is really needed and or whether it would tighten the position much beyond the normal expected level is what we need to decide. Of course, for sure, I'm not going to deal this proposition, that is the amendment proposed, in a very detailed manner for want of time, but I would definitely take you through the broad propositions that are coming out in the proposals. See, there is a penalty that has been brought in. See, whatever proposal I am discussing that is being brought in both the exemption regimes, both Section 12 regime and also in 1023C regime. See, there is a proposition to bring a penalty for any sort of violation of any of the provisions. In case trust or institution passes any unreasonable benefit to any trustee or any person specified in Section 13. See, you have been observing in the trust assessment, there is always a dispute with reference to a particular salary being paid to a trustee or the founder of the society, if at all he is working full-time for the advancement of the objects of the trust or institution. There are a number of cases which have laid down the ratio that payment of reasonable salary to the trustee or the founder of the society, if at all he is working full-time for the institution, is not to be considered as unreasonable benefit to such person or misapplication of the income of the trust. In spite of it, there has always been a complaint from the revenue on this front, and now the proposed penalty says if at all any unreasonable benefit is passed on to a trustee or a person specified in Section 13, then there would be a penalty of an equivalent amount, whatever amount that has been quantified as unreasonably spent on the trustee would be the same amount which would have to be paid as a penalty by the institution. That is only for the first time. If at all this violation is going to occur, second time it would be 200% and for all the subsequent times. So this is one thing we need to bear in mind. And readily they are coming up with a proposal that the principal commissioner who has power to register the institution has a power to cancel it, which we have seen this proposition some 5, 6, 7 years back, if I remember right. Those times, the law was interpreted in such a manner when once the trust or the institution was granted a 12-year registration by a commissioner, there is no way he can cancel or withdraw the registration, but such power was explicitly brought in by the provision some 7-8 years back. Since then, this power is being expanded in a manner which will create a lot of discomfort to genuine and deserving institutions that are going to really pursue the objects of the institution. So be that as it may, if at all the principal commissioner or the CIT has any inkling of doubt that the objects of the trust or institution are not being pursued in the right earnest, then he can call for documents, information, make any inquiry and pass orders for cancelling or refusing. Either he might restore the, either he might allow the registration to continue if he is satisfied with the representation, or he might cancel the registration as well. The order regarding the cancelling and refusing the cancellation shall be passed before the expiry of 6 months from the end of the quarter in which the first notice is issued by the concerned principal commissioner or the commissioner. Allowing certain expenditure in case of denial exemption. What happens if the exemption is denied? Then the trust or institution would be subjected to the normal computational provision and you will have to offer the income. At that point, thank God, they are going to consider some basic expenditure against that without considering the entire receipts as the income. And here, there is a new charging provision that is being brought into the statute book in the form of 115 BBI. 115 BBI is going to quantify what is the specified income. Specified income arises when there is violation as discussed above. I would just read out some instances where you have the specified income coming up under 115 BBI. Just a minute, I'll just take a minute. Where there is application of income which is to be treated as unreasonable application of income or for the benefit of the person, the trustee or the founder. 115 BBI, yes. See here, for the purpose of this, what is the specified income? Income accumulated or set apart in excess of 15%. As you know, 85% has to be applied for the objects of the trust or institution, and only 15% can be accumulated. If at all the accumulation is more than 15%, you will invite this application of specified income concept. And deemed income referred to an explanation to proviso to clause 1023C. Any income which is not exempt under clause on account of violation of the provisions of clause B. Violation of the provisions means application of income for the benefit of any trustee or the founder of the association. And similar provisions are there. In all these instances, you are going to quantify the income as a specified income, deny the exemption, and then apply a new charging provision, that is 115 BBI, which says it would be charged at 30%, no deduction of any expenditure or allowance or set off of any loss. This is very, very draconian. See, in spite of, okay, I do agree there is a violation, you are going to bring it to tax. Bring it to tax in the normal manner. Why are you applying 30% without any expenditure or allowance or set off? This is something akin to what is being proposed in the virtual digital asset or cryptocurrency, which we are going to discuss a little later. So suddenly the trust or the association cannot become a villain of the day. In spite of having a track record for so many years, okay, they would have committed some sort of violation on account of inadvertence. It doesn't mean that you have to put them under a special regime of taxation, and that too the most harshest way of taxation, stating that no deduction of expenditure and allowance or set off of any loss is not allowed. This is all very, very a very unwelcome proposition. And there is also one more concept they are going to bring in. They are going to bring in the concept of 43B with respect to application of income. 85% of the institution's income is to be applied for the objects of the institution. That application hitherto is deemed to have been applied on an accrual concept. Why do you want to do away with the accrual concept and bring in the cash concept? That means unless it is actually paid and applied in that year, there is no way you can avail this benefit. So the concept what we have under 43B is stating that you must go by the payment basis. The same concept is being brought in here, which is also very harsh. See, sometimes it may not be possible for them to immediately apply. They would have made some commitment, or they would have used the provisions in such a flexible manner, which would amount to a constructive commitment. So such constructive commitments are not to be identified as complying with the provisions, and you need to be extremely careful. This is going to come up from 22-23 assessment year onwards. And disallowance of expenditure incurred against income, that is section 14A. 14A is the most vexed provision where you have plethora of litigation. And in fact, most of the litigation went in favor of the SSC, but in spite of it, the more the litigation which is decided in favor of the SC, the more the approach of revenue in bringing out restrictions and more amendments. As you know, 14A has come into the statute book way back in 2001, if I remember it. 2000, almost 21 years has created enormous litigation. So there have been representations, there have been, of course, disputes arising on account of the concept that there is no exempt income earned or received during the year at all. When there is no exempt income, in spite of my making the investment, if at all I have not earned any income during that year, how are you justified in disallowing deduction of expenditure, that too calculated in a fictional manner as per Rule 8D? Rule 8D is a fiction. Rule 8D simply says, I will calculate taking the investment value, opening investment value and closing investment value, some 1%, some averaging, and all that. It's all in a fictional manner they create. See, why do you want to go away from reality? You don't want to accept reality and exercise the taxing provisions. So that is where we have all the cause for litigation. In fact, now, having got Chettinad Logistics case, where Honorable Supreme Court held that if at all there is no income that is earned during the year, there is no exempt income, there is no way you can apply this provision. The same proposition was held by the Honorable Supreme Court in Oil Industry Development Board also. You have other host of cases like GVK Project and Technical Services. Now to neutralize this provision, neutralize the ratio laid down by the Honorable Supreme Court, now an explanation is being proposed to be brought in, which explanation is going to create the real hardship for the taxpayer. The explanation goes on to read like this: for the removal of doubts, it is hereby clarified that notwithstanding anything to the contrary contained in the Act, the provisions of this section shall apply and shall be deemed to have always applied. In a case where the income not forming part of the total income under this Act has not accrued or arisen or has not been received during the previous year relevant to an assessment year, and the expenditure has been incurred during the said previous year in relation to such income not forming part of the total income. This explanation is going to give the essence. The essence of this explanation is whether you receive the exempt income during the year or not. If you have investments in your balance sheet which are potential enough to produce the exempt income, we will exercise provisions of, we'll apply provisions of 14A and take recourse to Rule 8D. This is very unfair. And of course, this explanation is also creating again a scope for litigation in the sense that it says the expenditure has been incurred during the said previous year, that is telling. The explanation is giving two limbs. One is whether you have earned exempt income or not, whether you have received exempt income or not. At the same time, it also categorically mentions that you should have spent monies as expenditure in relation to this exempted investments which are potential enough to produce exempt income. See, we have one subsection in Rule 14A which says 14A it's a very troublesome provision which says the provisions of subsection 2 shall also apply in relation to a case where the assessee claims that no expenditure has been incurred by him in relation to the income which does not form part of the total income. See, now they are telling whether you incur, whether you earn income or not, the provisions would apply. Already there is one subsection which says, if you take a plea that there is no expenditure that is relating to these investments which are potential enough to produce exempt income, no expenditure has been incurred, even then we will apply this provision. This is very unfair. What I mean to say, the subsection 3 is going to conflict with the requirement that is mandated under explanation second limb. This will create further litigation. And these provisions have, the proposed provisions are going to neutralize the ratio laid down by the Honorable Supreme Court, and which ratio is followed by other Delhi High Court and other Punjab and Haryana High Courts and all that. So this provision definitely is going to engage our attention, and we will be really bothered how to apply these provisions in the case of a company or a non-corporate, whoever it is, the 14 years are applicable across the board. And then we will quickly come to the exemption medical treatment of COVID-19. In June 2021, Ministry, the finance government has announced that whatever expenditure that is incurred in relation to the illness of COVID treatment would be exempt from income. But they have not come out with any rules or any clarity at that point of time. That promise which has been which has been made by the government has been converted into specific provisions in the proposal now. Now it says 56(2)(10), which talks about any gifts received or any amounts received or any benefit received without corresponding consideration being paid. So in that 56(2)(10), we have certain exceptions which will not be classified as an income taxable in the hands of recipient. So there you have added, you are going to have one more exception, which exception says any amount received by an individual from any person, please make a note, from anybody, it could be from his employer, it could be from any other well-wisher, in respect of any expenditure actually incurred by him on his medical treatment or treatment of any member of his family, in respect of any illness related to COVID-19, shall not be treated as income of such person as per 56(2)(10). Okay, then comes the second limb, which says, if at all, unfortunately, the person who suffered with COVID-19 infection dies, if he is dead, then the amount received by the family member of the deceased person from the employer, if at all he is an employee of a company or an institution or an entity, then whatever that is received from his employer would be exempt from tax without any limit. Okay, if at all such ex gratia is received from a non-employer, from any other person, then that is restricted to 10 lakhs of rupees, up to 10 lakhs of rupees received within 12 months from the date of death of such person. And family, here we have mentioned any member of the family. Then what is the definition of the family? You have to go and check section 10(5) explanation 1, which says family includes spouse, parents, sisters and brothers who are dependent on the on the SSC. So this is what is family. This is effective retrospectively from April 1st, 20 means that is 2021 assessment year onwards. Then we have the new explanation coming into the section 37. So this is very interesting where we need to have some discussion. Now the revenue has come across lot of payments for the benefit of medical practitioners happening in the form of gifts from the pharma companies to promote their products. A lot of freebies are given and gift coupons are being given. Sometimes the doctors are taken on a holiday trip at the cost of the companies with their family. So all this has caught the attention of the lawmakers. And in fact, we have plethora of case law with respect to various compliments, freebies, and benefits being passed on to these medical practitioners. We have a host of cases which is listed out in the memorandum explaining the provisions. We already have explanation 1 which says, explanation 1 talks about 37 which says, 37 says any expenditure which is an offense or prohibited by law is not going to be allowed. That is what is section 37 explanation 1, which was incorporated in the statute book way back in 1998. The explanation 1 has been brought in, I will tell you, 54 that is inserted with the Finance Act 1998, which says, for the removal of doubt, it is hereby declared that any expenditure incurred by an assessee for any purpose which is an offense or which is prohibited by law shall not be deemed to have been incurred for the purpose of the business. This is what is there in explanation 1. You know what is the genesis of explanation 1? See, any expenditure you incur cannot be allowed if at all it is against the public policy. Way back in 97, there was a tribunal decision rendered by the Mumbai bench of the tribunal in Pranav Construction's case, where extortion money paid to gangsters by a construction company to do their business in a smooth manner was allowed as a deductible expenditure under section 37, was not allowed by the assessing officer, which got allowed by the tribunal. The tribunal said there is no embargo on allowing any sort of expenditure. We know, we will discuss about Pyara Singh's case as we run through the virtual digital asset, that is cryptocurrency, whether it is legal or illegal. Pyara Singh's case, Honorable Supreme Court said, whether the income is legal or illegal, that is taxable. Just because it's an illegal income, it is not exempt from tax, which we all know. Pyara Singh's case is the landmark judgment of the Honorable Supreme Court. In the same tenor, can you also not argue whether the expenditure are legal or illegal? If it is definitely spent wholly and exclusively for the purpose of the business, it should be allowed. That was the argument made before the Mumbai bench of the tribunal, which has found favor, and the judgment gave relief, giving directions to allow expenditure incurred by the construction company SSE in the nature of extortion money paid to the gangsters. Then readily, 98 budget, we had a explanation 1 which said, whatever expenditure you incur, if it is for the purpose of any offense which is prohibited by law, if you are incurring an expenditure which amounts to an offense which is prohibited by law, then the same is not deemed to be spent wholly and exclusively for the purpose of the business. Now there is an effort to expand such explanation by bringing in another explanation that is called explanation 3. We also have explanation 2, which talks about corporate social responsibility, which is not the subject matter of the discussion now. Explanation 3 says, explanation 3 is going to say, for the removal of doubts, it is hereby clarified that the expression expenditure incurred by an SSE for any purpose which is an offense which is prohibited by law under explanation 1 shall include and shall be deemed to have always included the expenditure incurred by the NSSE for any purpose which is an offense under or which is prohibited by any law for the time being in force in India or outside India. That is what you need to make a note. Even though you are a multinational corporation, you have businesses across the world, by any chance you incur some expenditure in respect of an offense committed outside India, even such expenditure must be disallowed now. Okay, so but it is very interesting here. The explanation is going to provide any benefit or perquisite in whatever form to a person, whether or not carrying on business or exercising a profession, and acceptance of such benefit or perquisite by such person is in violation of any law, rule or regulation or guideline, as the case may be, for the time being in force, governing the conduct of such person. See, you are not going by the, of course, the public policy is the underlying concept, but you are even going to such code of conduct which is supposed to be adhered to by such person who is getting governed by such code of conduct. Take the case of the medical practitioners who are receiving freebies and gifts from pharma companies. Pharma companies give this to promote their products. If they come out with a new product, they will seek the support of the medical practitioners so that they prescribe those new products to the patients, and in turn, that product gets popularized. So this sort of freebies and gifts are against the code of conduct as decided by the Indian Medical Council. Medical Council has got its own code of conduct, as how we have code of ethics by the institute. There is a code of conduct which is always there, which needs to be followed by the medical practitioners. If at all your expenditure, that is the pharma companies giving gifts, which is in conflict with the, or which is in violation with the rules of code of conduct of such medical practitioner, that is good enough to conclude that this is against the public policy, and all such expenditure would now be disallowed in the hands of the pharma companies. Okay, then you have to compound an offense under any law for the time being in force in India or outside India. Anywhere. If you, first we talked about an offense which is prohibited by law within India or outside India. If at all you compound such offense and make payments, such expenditure is not going to be allowed as an expenditure which is incurred wholly and exclusively for the purpose of the business. So this is where you need to be extremely careful. However, this explanation is going to be effective only from 1st April 2022. And this is the case law which got neutralized and which got confirmed. Friends, here there is one more concept which you need to bear in mind. Whenever you make any payment for a particular offense or a violation of law, it might have two dimensions. One is whether the payment is compensatory in nature or whether the payment is penal in nature. This concept has been upheld by the Honorable Supreme Court and also the other high courts of the land. If at all it is compensatory in nature, that is to be allowed as an expenditure. If at all it is penal in nature, then it has to be disallowed as per explanation 1. So we have a whole host of judgments on this, and this is where we need to really figure out and see, even in the advent of this new explanation coming into the statute book, whether the offense or the corresponding payment of the fee, whatever you may say, whether such fee is penal in nature or whether it is compensatory in nature. If at all it is compensatory in nature, you have a case to fight for its allowability, which we need to bear in mind. And then coming to the cess and surcharge, all of us know this is one this is one provision this amendment is highly justified. There is no doubt, though it is going in favor of the revenue. It is highly justified. For the simple reason we have Supreme Court judgment of K. Srinivasan's case. See what has happened. Some corporates started, some large taxpayers, they started claiming cess, that is the higher education cess, as an allowable expenditure. 48(2) clearly says tax is not an allowable expenditure while computing the total income for the purposes of income tax. Surcharge, anyhow, it is also settled proportion. Surcharge is not agitated by these taxpayers. It is kept on par, on the same footing as that of tax. But they started claiming this higher education cess, which started in 2005, is to be allowed as an expenditure. As how foreign taxes in the context of international taxation sometimes are allowed, in the same manner, this was started stating that this is not of a tax character of a tax, so hence it has to be allowed. Then we had some judgments coming from Rajasthan High Court and other high courts endorsing this approach. However, the whole endorsement happened on the basis of circular given by the board in 1967, way back in 1967, talking about a cess. The word cess used in that circular was used in a different context with respect to cess charged by a state government, not by the central government. Overlooking that concept, the word is borrowed from that circular, and some courts have granted relief, holding a view that the cess is a deductible expenditure. But we also have judgment coming in favor of the revenue, which rightly relied upon the Supreme Court judgment of K. Srinivasan, which is listed out in the memorandum explaining the provisions, which you can see. In K. Srinivasan's case, the Honorable Supreme Court clearly told that cess is an additional surcharge. When once it is an additional surcharge, it sits along with the surcharge and gets twined with the tax, income tax, and thereby the whole chunk is not a deductible expenditure as per 48(2). This is what is the intention of the legislature, which is rightly so. And then accordingly, an explanation has been brought in with a retrospective effect, stating that it is never to be understood as a cess of a state government or cess of that nature, which is deductible as an expenditure. So this is what you need to bear in mind. And this goes retrospectively back to 2005-6 assessment year on. These are all the cases which got overruled, which went in favor by the analogy what I have explained little earlier. Of course, this Kanoria Chemicals case of the Calcutta tribunal upheld the revenue's contention that cess is not allowable, basing on the ratio laid down by the Honorable Supreme Court in K. Srinivasan's case. And conversion of interest payable to debenture or other instruments. You already have one provision in 43B, which says that any loan against any loan, if interest is unpaid to a financial institution or a bank, the interest payments are also covered by the 43B, you know. If at all such unpaid interest gets converted into a loan or a borrowing again. Many times we see when we go for a bank audit, the funding of the interest gets funded, and it on the restructuring, you see that the interest unpaid on the basis of restructuring becomes a new loan. As per the banking perspective, that is deemed to have been paid because it gets a new lease of life with new terms and conditions. But that constructive payment approach is only from the banking parlance and not from the tax parlance. Already we have explanations 3C, 3CA, and 3D, which says in case of financial institution, in case of banks, in case of cooperative banks, in all these situations, in case of NBFCs, not cooperative banks, NBFCs, but cooperative banks also will join the scheduled bank category if at all they are covered. If at all the unpaid interest portion is getting converted into a loan, it is not to be treated as a payment for the purpose of 43B. The same analogy, now it is proposed to be expanded with respect to conversion of such unpaid interest into a debenture or a similar instrument. A categorical amendment in those same lines is being brought in, expanding or modifying those explanations so as to include conversion into any debenture or similar instrument would also not to be treated as payment of interest for the purpose of section 43B, which is effective from 23-24 assessment year. And the cases overruled and case laws confirmed are given here. And then we will quickly go to loan or borrowing sources of fund of creditor, section 68. Very interesting. See, we know section 68 is one provision which is the biggest redeeming fiction, and where you have plethora of case law, and thereby it has become a judge-made law. Though the section looks deceptive, originally it was a very short provision. Then the lawmakers started adding, explanations and all this. And coming to section 68, what has been done now, it is simply provided that if at all you have a loan or a borrowing, I'm sorry, I have gone to the next slide. I'm sorry. So as to provide that nature and source of any sum, whether in the form of a loan or borrowing or any other liability credited in the books of account, shall be treated as explained only if the source of funds is also explained in the hands of the creditor or the entry provider. That means you are asking source of source. Source of source was never to be discharged by the SSC or the taxpayer. We have got Daulatram Ravatmal's case way back Supreme Court in 1973 held that source of source is not to be questioned in the hands of the taxpayer. If he is establishing the source, that is good enough. You know, Shankar Industries case, Calcutta High Court laid down 3 important criteria for the purpose of section 68, which we all religiously follow. That is the identity of the creditor, credit worthiness of the creditor, and genuineness of the transaction. These 3 dimensions, if they are taken care by the taxpayer who receives this credit, his bonus is discharged, and then the bonus shifts to the revenue. We have a whole host of case law in this regard. While deciding what is the burden of proof cast on the taxpayer, we have this concept which was argued before the Honorable Supreme Court in Daulatram Ravatmal's case, where the Honorable Supreme Court way back in 1973 held that source of source is not to be questioned in the hands of the taxpayer. Then virtually this proposal is going to neutralize that ratio laid down by the Honorable Supreme Court. If at all you have a loan or borrowing, you will also have to establish the source of the source, that is, where from such creditor got this amount and what is his source for him to lend it to the taxpayer. This is too much of what is being asked from the taxpayer, but unfortunately we live in these times of draconian rules sometimes coming in this form. Of course, this was already there in section 68 with respect to share application money coming from the received by the corporates. You know, you had, I don't know whether you remember, 18 years back, we had Sophia Investments case and Stellar Investments case coming from the Delhi High Court, if I believe, or Delhi Tribunal, or Delhi High Court, holding a Sophia Finance and Stellar Investment, stating that if at all the shareholder, that is share applicants, whose money is received as a share application money, if they are identified, that is good enough, and the bonus is discharged by the corporate, and you cannot go beyond that. Where from those applicants have brought this money to invest in this share capital is not to be questioned in the hands of the corporate taxpayer. That has been undone by virtue of an explanation which has already come some time back in section 68. Now this is an addition to that. After this, then we can really introspect and question ourselves, what is left in section 68? If at all, loan borrowing may have a broader interpretation to cover any advance, any credit coming into the books. Then you are now mandated to establish source of source, which is really going against the basic concept what we have learned in the theory of cash credits in section 68. Section 68 has already got a proviso which says that anything which is credited in the form of share application money or share capital or share premium, there also such bonus is cast on the corporate taxpayer to establish the source of such share applicants, such shareholders. Here also it is coming, that is in the case of a closely held companies, of course not in the widely held companies, but now here this loan and borrowing can apply across the board to every SSE. And then strategic PSU disinvestment carry forward of losses, section 69 is amended to facilitate PSU disinvestments happening like Air India and other companies. And Honorable Finance Minister also mentioned that another 11 or 12 PSU disinvestments are underway in full force. So in this backdrop, I think this 79 carry forward of losses is a facilitating provision for the public disinvestment, where it says the ultimate holding company continues to hold that 51% of the subsidiaries which have divested their investments. As long as that 51% is held, the losses must be allowed, because there is a transition period is always created. So the transition period will enable these before the new stakeholder takes over the entire share capital, there is a transition period. In transition, this is what has been mandated. And then there is one more new provision has come into 79A. This proposes to insert a new section 79A, which says, if at all there is an undisclosed income which has been quantified on the basis of a search operation or a survey operation, or on the basis of proceedings connected with search 132A, no set off of any loss brought forward will be allowed against the undisclosed income quantified on account of these actions. Definition of undisclosed income again is given in the in section 79, new section 79, which is also very interesting. When we talk about undisclosed income, what are we reminded of? We are reminded of the block assessment and undisclosed income. If I am not wrong, I think that was chapter 14B or something, or 14, if I'm not very sure of the chapter number, but block assessments and undisclosed income. So there again, you are traveling back to the concept of undisclosed income and trying to see whether the undisclosed income quantified by the assessing officer would be the same what is now envisaged under 979 or not. This is where you have again a whole host of discussion coming up. And here, with respect to this 79A, undisclosed income, any income of the previous year represented either wholly or partly by any money, bullion, jewelry, or other valuable article or thing, or any entry in the books of account or other documents, so and so, found during the search operation or requisition under 132A or survey 133A, that is fine, and has not been recorded on or before the date of search of requisition or survey, fine, and not been disclosed to the principal chief commissioner or chief commissioner or principal commissioner before the date of search. Before the date of search, you are not disclosed it to the principal commissioner. And any income of the previous year represented either wholly or partly by any entry in respect of an expense recorded in the books or other documents maintained in the normal course relating to the previous, which is found to be false and which would not have been found to be so had the search not been initiated or survey not been conducted. So now you have a whole host of new concept which is maybe akin to the concept of undisclosed income, which we need to go back and pull out all the jurisprudence we have and see. See, this is again very unfair. Because you have an undisclosed income which is detected, I'm not going to give a legitimately accepted and endorsed losses which are being brought forward. And then NPS, that is the National Pension Scheme, where only central government employees were having the benefit of higher contribution by central government to the tune of 14%, which is allowed as a deduction. And state government employees were only having 10% contribution, which is identified as deduction. Even for state government employees now, the facility has been extended up to 14% on par with the central government employees with effect from 2021 assessment year. And then annuity to disabled persons, 80DD. As you know, 80DD talks about a person with a disability, a dependent disabled person, and if the taxpayer is paying annuity for his maintenance, and if such annuity is received after the death of the taxpayer who is contributing for that annuity in the form of a premium year after year, it was allowed as a deduction only if it is received after the death of the parent. Now, the proposal is, even if it is received during the lifetime of the parent who is a taxpayer, who is an assessee, that would be allowed as a deduction and it would not be brought to tax. And there was also a provision, with the existing provision says, if at all the disabled dependent predeceases the parent who is a taxpayer, then the whole amount of annuity received would be a taxable income in the hands of the parent. Now, there is an amendment which says this has been discussed by the Supreme Court in one of the cases, Ravi Agarwal's case, where the Honorable Supreme Court suggested to create more leeway in these provisions to provide more exemption situations, genuine hardship being encountered by the assessees and the dependents should be responded. That is to, as against this judgment, the revenue has come out with a new proposal to allow deduction also during the lifetime, which I have already explained. It is also proposed that section 80 DD3 shall not apply to amount received by a dependent, that is the before his death. Before that disabled dependent, if at all he receives before his death by way of any annuity or lump sum by application of the condition related to the proposed amendment. That means even if it is received during the lifetime also, that is not going to be taxed in the hands of the disabled dependent. And then startups, you have now the startup policy and the Make in India policy are being encouraged in a big way. As per the provisions, we have 80 IAC, which is the deduction provisions to provide exemption to the startups income with some conditions. And one of the conditions is the eligible startup should have been registered or incorporated on or before 31/3/2022. So that is being extended by 1 year. So this extension will help the startup industry because of the pandemic. There are a lot of dislocations in the industry, and this would really help genuine startups to have 1 more year breather for bringing up a new startup. And please let me know if I am not audible. If there is any audibility issue, please let me know, because I will be going in my own stream, not knowing whether I am really audible in or not. Chalangaru.
It is perfect, sir. It is perfect.
Please,
it is going well.
Please interrupt once you have any audibility issue. Okay.
Right. It's perfect, sir. It's good.
Okay. So coming quickly on bonus and dividend stripping, all through it has been applied against the mutual fund investments for high net worth individuals. This is applicable. Now, all units what are invested across the new variety of investments, that is the business trust investments, dealing with various investment portfolio and the real estate investment trust and alternative investment funds, whatever investments you make, now they have the facility of this bonus stripping and dividend stripping. What is bonus stripping? If you have some unit which is carrying a bonus declared, generally the value of that unit would be very high till the bonus is received. I mean, the bonus shares are allotted. Till such time, generally, if it is 1:1 bonus, the price would get doubled because it has one bonus share embedded in that share value. Once the bonus is shares are allotted, then what happens after the record date, the value falls to 50%. That is which is justified. So what happens after receiving the bonus shares, if you sell the shares, you incur loss. So that loss is what is the bonus stripping, which is not allowed to be carried forward. Already in shares and all that, that was extended to mutual funds also in the past. Now it is being extended to the units of real estate investment trust and alternative investment funds. See what happens, that loss which they incur on selling the shares after the record date of bonus shares, that loss will be adjusted against gains made on other investments sale. So this will not be allowed now, and thereby you will have to lose that part of loss incurred because of the bonus stripping and dividend stripping. And then these case laws are getting overruled on account of this amendment. Then new manufacturing companies' extension of the date of commencement of the production has been extended to promote the Make in India policy in a big way. Now the commencement date here is a bottleneck that was supposed to be commenced on or before 31st March 2023, which got extended up to 2024. You know, 115 BAB provides 15% concessional tax rate to manufacturing companies, provided they do not claim any deductions under the statute book like Chapter 6A deductions and other deductions which are listed out in the provisions. If those conditions are complied with, then that manufacturing company will have the benefit of, this is the first time a manufacturing company, it is not a split up or reconstruction. Such companies will be allowed this 15% concessional tax rate, provided they commence the production on or before 31st March 2023, which date got extended by another 1 year to take care of various problems and difficulties faced by the industry on account of the pandemic. So 1 more year extension will really help. And in fact, there was a representation by the industry asking this extension of 115 BAB even to the existing industries, existing companies, if at all they start a new manufacturing unit, but that is not allowed in the budget. Then this 115 BBD, as you all know, this is one of the most important international tax amendments. This is with reference to dividends received from foreign companies by an Indian company, provided such Indian company has share capital in the foreign company to the extent of 26% or more. It could be a wholly owned subsidiary also. This provision was brought into the statute book in 2011 by the then Honorable Finance Minister Sri Pranab Mukherjee. Later on, Sri Pranab Mukherjee became the President of India also, we all know. That time, the main purpose of introducing this provision, creating a concessional tax rate for dividends coming from foreign companies into Indian companies, is to encourage repatriation of profits back into this country, which was brought in as an amendment for only 1 year to start with through Finance Act 2011, which amendment got extended year-wise to another 2 or 3 years. Then the BJP government came into power in 2014. Then the first budget presented by the BJP government, the then Finance Minister, Sri Arun Jaitley, observed in his budget speech that this provision brought in the Finance Act 2011 has really produced encouraging results, bringing a lot of repatriation of profits back into this country from the foreign subsidiaries. Thereby, the sunset clause has been removed, and this provision has been made a permanent provision without any sunset clause in the statute book. Since 2014 till now, we have been enjoying the concessional tax of 15% for the dividends received from the foreign joint venture company. Once it is 26%, you can call it a joint venture company or a subsidiary company. Now, I don't know why this was tinkered. Suddenly, this amendment has been brought in, giving an explanation in the memorandum stating that the dividend taxation regime has undergone a change in 2020, dispensing with the dividend distribution tax under 115(o) and making shareholders pay tax as per the level of income they are earning. That means in whatever slab they have their income coming in the form of dividend, that would be taxed at that rate. So to bring parity with this dividend taxation which is happening in the hands of shareholders, it is proposed to dispense with 115 BBD, which becomes non-operative from 1/4/2023, that is from 23-24 assessment year onwards. That means corresponding financial year, that is 22-23. Any dividend you receive from a foreign subsidiary is going to be taxed at full rate in line with the slab of income in which you are placed. So this is very unjustified for the simple reason that domestic company dividend should never be compared with a foreign company dividend. Why? Foreign company dividends, because foreign companies are placed in a different jurisdiction in a country where the risk parameters are totally different and the operating procedures are different and the markets are different. When you are promoting such outbound investment, and when you the concessional tax rate what you have provided is justified, that cannot be equated with the domestic dividend and then dispense with this concessional tax rate. Even the Reserve Bank of India, monitoring all the outbound investments of the Indian corporates, takes the annual performance reports every year from the outbound investing company, that is the Indian company. It will closely examine and see what happened to your investment, whether you are repatriating any profits back into this country in the form of dividends. So this outbound investment structure, which is being encouraged by both the taxation regime as well as the RBI regime. Of course, RBI regime continues with their monitoring. That is why I'm telling about the RBI. Even RBI is always interested in tracking and knowing whether the dividends have been repatriated back to the company, the profits have been repatriated in the form of dividends. So when such instances are encouraged, even under the outbound investment policy, how can you dispense with this concessional tax rate now suddenly, which is highly unjustified? In fact, I wrote an article on 115 BBD, which is already posted in Tax Sutra some 4 days back. Interested members may visit Tax Sutra and see the article on this. And virtual digital asset, this is where we need to spend time. What is a virtual digital asset? The definition given is very, very exhaustive and very confusing. And you do not know what are going to be covered by that. When someone comes to you for a advice, you will not be in a position to know whether a particular transaction gets covered as a virtual digital asset. Let us just quickly see what is the definition given in 247A, that is the new insertion made in the definition provisions of the Act. 247 says, 1 minute, I'll just. 247 says, as any information or code or number or token not being Indian currency or any foreign currency generated through cryptographic means or otherwise by whatever name called, providing a digital representation of value which is exchanged with or without consideration, with the promise or representation of having inherent value, or functions as a store of value or a unit of account and includes its use in any financial transaction or investment, but not limited to investment schemes, and can be transferred, stored, or traded electronically. See, this is what is mentioned by Mr. Kamlesh Varshni, Joint Secretary, that day when he is in the panel. He was asked where from this definition has come. Then he said, this is one definition which we are toying with for the purpose of bringing a law on cryptocurrencies. Which law has not been tabled? Which bill has not been tabled in the Parliament for the present? But the taxation rules have come first. Without regulating what is cryptocurrency, the taxation rule has come very fast. You would have seen in 2020 when pandemic started, equalization levy 2.0, that is levy on non-resident e-commerce operators, was brought in without proposing it in the bill. It straight came into the Act, Finance Act 2020. Please go and check. Because the pandemic is going to improve the digitalized businesses, and the government doesn't want to lose the opportunity of charging such businesses to tax. In the same manner here, they do not want any further delay in bringing the taxation proposal. Bring the highest possible tax and tax all the transactions. Then we will see what is the cryptocurrency law when the bill is tabled and what is the regulation. So this is how the cryptocurrency transactions are going to be brought to tax. We need to call them as virtual digital assets. That is the coinage given in the finance bill, and which definition I have just now read, which is very, very exhaustive. Tremendous popularity gained by the virtual digital asset, a new scheme with a new charging section 115 BBH. 115 BBH has come into the statute book, and you need to be very, very attentive about that. How it is going to overlap with some of the existing transactions is a very interesting issue, which we need to bear in mind. So before going into virtual digital asset, how there is going to be tax, that is at the rate of 30%, only taking cost of acquisition and no other expenditure, always to be treated more like a gain. That is, the asset means it is a capital gain, though they are not calling it a gain. Though they are not calling it what is the long-term capital gain and what is short-term capital gain, any gain you make on that, you pay 30% along with surcharge and cess. That is good enough. That is the maximum tax that is going to be collected. At least 1/3 of your gain is being paid as tax. Okay. And then taxation proposal does not legitimize the cryptocurrency. That is what has been clarified immediately by the Honorable Finance Minister in the press conference. Even the Revenue Secretary, Mr. Tarun Bajaj, has clarified the same as the stand of the government. Just because we have brought in taxation provisions of the virtual digital asset or the crypto assets, it doesn't mean that the same has been legalized or legitimized. That needs to be borne in mind. And then already in India, we have as many as 10 crore investors in cryptocurrency from last 1.5 years. You have been hearing this crypto news since last 1 year in a big way. In the pandemic, a lot of investments have gone into crypto. and around 6 lakh crore Indian rupees is invested into crypto assets. Everyone was keeping their fingers crossed whether there would be a total ban on these crypto assets. Thank God there is no ban, but there is a harshest, most harsh tax regime to start with. And then there is a spurt in trading volumes after the taxation announcement. There is a spurt in the trading volumes because the market has taken this announcement as a partial endorsement or legitimizing this crypto asset trading. So they have taken it as a positive news, and the cryptocurrency trading has increased. Simultaneously, the government has also announced central bank's digital currency, that is the digital rupee, is going to come very soon. That is in the year financial year 23, that is 23-24. 22-23, you are going to have 22-23, you are going to have digital rupee. And then there is also some sort of bonhomie, some sort of joy among some taxpayers stating that whatever I have done till now, because this new regime is going to come only from 1/4/2022, whatever I am going to deal with up to 31st March 2022 is not going to be taxed. Wrong. The existing provisions will take care. This is where I want to again bring the ratio of the Honorable Supreme Court, whether the income is legal or not, whether it is legitimate or illegitimate. Pyara Singh's case, Honorable Supreme Court held it is liable for tax. So in the same breath, it is to be noted that there is no question of any exemption for the transactions that are going to be recorded up to 31st March 2022. Probably up to 31st March 2022, you have to think that you had a more liberal tax regime where probably you can canvass for a long-term capital asset or a short-term capital asset, or depending on the number of transactions what you have, you may ask for the nature of business income, which nature has been totally ruled out in the new tax regime of 115 BBH. So even that has been clarified by the CBDT chairman, Ms. Mahapatra. From the last 2 days in his press conferences, he told, we are not going to spare any crypto transaction. Even prior to 31/3/2022, the old rules, the existing law would apply and we'll bring it to tax. And here we need to understand the new regime, how it's going to operate. The new regime is going to operate at the rate of 30%, taking only cost of acquisition to be deducted. Thank God at least cost of acquisition is being deducted. And no other expenditure that can be allowed here, even the selling expense, whatever it is, nothing is going to be allowed. And no set off of losses is allowed. No deduction in respect of any expenditure or allowance or set off of loss shall be allowed to the SSE under any provision of the Act while computing this income. See, this is where there is some sort of dichotomy we have in the new provision that has been brought in, that is being proposed. Notwithstanding anything contained in any other provisions of this Act, no deduction in respect of any expenditure other than the cost of acquisition or allowance or set off of any loss shall be allowed to the SSE under any provision of this Act. Here it is being used as any provision of this Act. That means including the provision of 115 BBH. Why I am saying so, the immediate question is, okay, my loss incurred against a virtual digital asset cannot be adjusted against my gains made on sale of shares. Fine. At least will I be allowed to adjust my loss on virtual digital asset against gain made on another virtual digital asset? That question is bothering the minds of all the investors. This is where the subclause A of subsection 2 says any provision of the Act will go on to say no question of adjusting this loss against the gain will be taxed, loss will be ignored. It is very unjustified. But when you come to clause B, which you can read from the finance bill, no set off of loss from transfer of virtual digital asset computed under clause A of subsection 1 shall be allowed against income computed under any other provision of this Act. There they have used other. In the earlier subclause, they have used any provision. Here it is any other provision of the Act to the SSC, and such laws shall not be allowed. There you can take a meaning that these laws cannot be adjusted against gains made under the other provisions of the Act. Gain made under virtual digital asset cannot be adjusted against laws under the other provision, but can be adjusted against the loss incurred in these provisions, under these provisions. So that is where experts now feel clause B of subsection 2 BBH is giving a leeway for virtual digital asset gains can be adjusted against virtual digital asset losses. So this is what is a very interesting thing which we need to bear in mind. I have already discussed about the Pyara Singh's case, and there is also a TDS that has been proposed at the rate of 1%, is a very powerful tool to track all the transactions. See, these transactions have to be necessarily go through a crypto exchange. There are a number of crypto exchanges, Coin CDX, Coin Switch, Coin Switch Kuber, so many cryptocurrencies. There are as many as 8,000 cryptos that are doing rounds in the market, in the international market. Countries like Estonia in Germany and Slovenia both have legalized this as a legal currency. And number of European countries promote this in a big way. Of course, the entirely opposite approach is from China, where they have banned cryptocurrency totally, and they have already issued a digital currency. And in fact, among the African countries, Nigeria is one country which has already issued a digital currency officially from the central bank. So be that as it may now, this 1% needs to be deducted by whom? This 1% needs to be deducted under section 194. Yes, that is what is being proposed. 194S goes on to say, I'll just take you to 194S, which says, any person responsible for paying to a resident any sum by way of consideration for transfer of virtual digital asset shall at the time of credit of such sum to the account of the resident or at the time of payment of such sum by any mode, whichever is earlier, deduct an amount of equal of 1%. There are two views doing rounds here. Whether this TDS obligation under 194S new provision, is it cast on the seller of the virtual buyer of the virtual digital asset who buys and pays the seller, or is it on the crypto exchange? I read it practically and understand that this is the crypto exchange which is obligated to do this deduction and pass on the balance to the seller. So that is where they are going to get huge data from the crypto exchanges about the transactions that have happened. This is what is confirmed even by the CPE chairman. So the wrong interpretation, or the maybe a wrong interpretation, would be the buyer has to know. No, the buyers are individuals. You can't track them. It is difficult to implement 194S being a procedural provision. It is very difficult. So that is the reason they have cast this obligation on the crypto exchanges and not the individual buyers. And whether equalization levy 2.0, it might overlap on some of the transactions, because this is all being done electronically, virtually. When you go to the definition of EL 2.0, which deals with non-resident e-commerce platform, if a non-resident cryptocurrency exchange is dealing with a resident's transaction, whether that non-resident crypto exchange is being slapped with EL 2.0 also is a question to be discussed. Then comes a discussion about 194O with respect to resident e-commerce operators. There is a 194O 1% deduction. There is a discussion whether 194O applies or this 194S applies. It's clarified that 194S applies as per the proposed provision. And there is a exemption provision being given. Some sort of relaxation is given with respect to this 194S to specified persons who are individuals or HUF having turnover or gross receipts not exceeding 1 crore and our income from profession not exceeding 50 lakh. If at all they are showing it as a professional income and carrying out this crypto exchange like activity, then they are not subjected to this 194S because they do in a very small way because their thresholds have been kept at 1 crore and 50 lakhs. It doesn't apply to them. So this is what, friends, is regarding the virtual digital asset, and the definition is very complex, and I don't want to go beyond this because for want of time. And non-fungible tokens, what are non-fungible tokens? What is a fungible token? Fungible token is an exchangeable token. You can exchange, that is like a barter system. You give this token and take another token because which has the same intrinsic value. Assets in metaverse. Metaverse is a new technology which is being promoted by Facebook today. That is the new buzzword in technology. Metaverse will create, they're all, now everyone is bored of social media. They don't want just Facebook, they want something more. What something more? That something more is being propagated or being researched by Facebook, that is called a metaverse technology. Metaverse technology, my friend in Vizag and me in Hyderabad, we both can sit and create a virtual reality and a 2D or 3D technology. That is what I understood in my limited reading. 2D or 3D atmosphere would be created. It is all through internet only. And I feel as though my good friend Mr. Kamshastri is sitting in front of me, or my good friend Mr. Chalam is sitting in front of me and talking to me. So this is the metaverse technology, and how this is going to impact cryptocurrencies, what implications, is very mind-boggling to think all about this. And for your information, US government in Washington has not yet approved this metaverse technology to be used full length for all the applications. That is where Facebook is lobbying for its acceptance by the US government. Be that as it may, all top companies, even the now even Indian software giants have become multinational like TCS, which is the highest value earner now, and TCS and other Infosys, they're all ready to get into metaverse technology. And digital currencies would be the order of the day. India is going to release this, and this is what is all about this virtual digital asset in the limited time available. And then let us quickly discuss about the updated return, very, very important concept being brought in. Updated return is being brought in as a new subsection 8A in 139. It can be furnished within 24 months from the end of the relevant assessment year. This is going to start from 23-24 assessment year. Okay, that means if at all you have a return file for 23-24, you have an option to update such a return within 2 years. That means within 2 years from the end of the assessment year. 23-24 assessment year will end on 31st March 24. From there, 2 years you have up to 26 March, you have the chance to file an updated. What is this updated return? Never ever we have heard about it. We know about the original return. We know about the belated return under 139.4. We know about the revised return under 139.5. But we have no idea as to what is updated return. As you observe, the timelines for filing these returns have been reduced over a period of time. Even the assessment deadline dates have been pruned down and bringing the time available because of the vast computerization and a digitalization of the income tax proceedings and filing of returns. Of course, keep aside the present glitches in the portal which are bothering all of us. That is, keep it aside. But definitely a very heartening computerization has happened, which we have been experiencing more so from last 7-8 years. In the advent of computerization, in the advent of mass assessments that can happen in a speedier manner, the time limits have been brought down. Thereby, the chance of revising your return gets exhausted very fast. And now the order of the day with the computerization, the entire Jataka Chakra of the SSC is available in the form of annual information system, annual information statement. That is what we need to check. Now, when you want to upload a return, the SSC brings and gives some, gone were the days when he can bring selectively some information and ask you to file the return. In his own interest, you will check AIS and say, Baba, you have some more transactions on which you earned income. Please include them, otherwise you will be in trouble. So that annual information system is a mirror image of all your transactions available with the revenue and also with the taxpayer. So revenue, to avoid reassessment proceedings in a large manner in number of cases, to save their own time, they would like to inculcate voluntary compliance by the taxpayers themselves. Of course, the voluntary compliance also is improving in a heartening manner, there is no doubt about it. Keep aside the minuses, but broadly we should acknowledge them. So in this philosophy, now the updated return is being brought in to provide one more opportunity to the taxpayer to come up clean and offer those items of income which have been missed out in the original return. Okay. Even though you have filed revised return, also you can file this one. Even though you have not filed, then also you are eligible. Increasing the total refund. See, the not 139.8A shall not apply if the updated return is a return of a loss or has the effect of decreasing the total tax liability, determined or increasing the total refund due on the basis of the return furnished under 139(1), 4 or 5. 1 is the original return, 4 is related, and 5 is revised. So a person shall not be eligible to furnish an updated return under 139(8A) if search has been conducted under section 132 or a survey has been carried out under section 133A or 132A provisions have been invoked as a consequence of such operations, then you are not eligible to file any updated return. And then also no updated return shall be furnished where an updated return has already been filed for the return. That means if you have already filed updated return, there is no revision of such updated return anymore. Only once you can file an updated return. Proceedings for assessment, reassessment is pending or completed. If an assessment notice by the faceless scheme is given to you, you are not eligible to file an updated return. AO has communicated, same way reassessment proceedings have started, no, you are not eligible. AO has communicated possession of information under the Prevention of Money Laundering Law, that is the PMLA, which is the most draconian law. PMLA is also regulated by the same RBI along with the FEMA regulations. So if AO has committed some violations under PMLA and the SSC has committed some violations under the PMLA law, and AO has got such information about him, then he informs the SSC that he is in possession of such information, then such taxpayer or SSC is not entitled to file the updated return. And if at all there is any exchange of information under the DTAA, under section 90 or 90A from the specified jurisdictions, on account of seamless exchange of information now happening, and even Swiss Bank is now arm twisted and it has to give information about the account holders, which has come in the form of Panama Papers, Paradise Papers. We have several leaks of information which is being closely examined by the tax department now. Prosecution proceedings, if they are underway and initiated, and such other persons who are notified as not being eligible to file the updated return, they have no chance to file. See, the updated return is valid only if you pay taxes under 140B. It is akin to 140A self-assessment tax. You have to compute yourself what is the quantum of tax you have to pay as per the regular tax rate and interest for the delay. And not only that, you will have to pay 25% as an additional tax if at all you are filing updated return within 1 year from the end of the assessment year, or within 2 years and beyond 1 year, it is 50%. You have to pay this and then file. If at all you don't pay it correctly, then your updated return would be defective and you will invite all sorts of troubles because you have already given all the information about your income without properly paying the corresponding tax. So proposes consequential amendments and everything will follow. But there is one point which is really bothering all, the stakeholders or the SSC community is, there is no whisper about the penal proceedings. Tomorrow, the assessing officer, can he, the faceless under the faceless scheme, can he initiate concealment penalty stating that this is not reported in the original return or the revised return? So that is not answered. That is $1 billion question. Unless you clarify that the updated return would not have all the encouragement. That is what everyone thinks. But anyhow, this is a very, very good concept. The faceless assessment scheme, we know how it's being implemented. The principles of natural justice are being violated grossly because the taxpayer in the faceless assessment scheme is not being provided with sufficient opportunity to file the details, and there is no sufficient uploading space beyond 10 MB for the huge data that is being called for. And the CVDTA has clarified that 500 MB would be provided for taxpayers to upload the information. I'm not sure whether it has been initiated yet. That is the position. You have a whole host of complaints from various quarters which have gone to the various high courts in the form of writ petitions, and across the board from all courts, Rajasthan High Court, Delhi High Court, and even Calcutta High Court recently have dismissed faceless assessments. And most of the high courts, of course, even in the context of 148 proceedings, which will come later, you had a host of decisions coming in the Ekambaran Sukumaran's case and number of cases, Parag Kishore Chandra Shah's case, where the Honorable Bombay High Court held that the proceedings initiated with faceless and orders passed are quashed, treating them as honest for want of principles of natural justice, for compromising on principles of natural justice, and even the assessing officer under the faceless scheme was slapped with the penalty and costs. So, but now the entire faceless assessment scheme is being revamped with more or less identical provisions. But one significant change is there is one subsection 9, which is very, very dangerous for the revenue themselves, because which says if at all the procedure prescribed under the faceless scheme, which is mainly brought in to avoid interface between the taxpayer and the assessing officer, and has to go only through electronic mode, if at all the procedures are not complied as per the provisions of 144B, the entire proceedings will be honest. That means honest means there is no cure for this. You can't cure the proceedings. There would not be any rectification. The entire proceedings will crumble. So that is a very suicidal provision. Which provision has been dropped now? Section 9 has been conveniently dropped. More or less all the provisions got repeated, except it is proposed that all communication with the SSC or any other person may be necessary for the purpose of making a shall be only through National Faceless Assessment Center, which is to be headquartered in Delhi, headed by a principal chief commissioner. And you have assessment units, you have review units, you have verification units, you have technical units. No one is going to interact with you except NFAC will interact with you, that is through electronic means. If at all you want any hearing, it can be conducted only through video conferencing or video telephony to a maximum extent of 30 minutes as per my reading. And one change what they have done is that is dropping that subsection 9, which is really bothering them. And having regard to the nature and complexity of the accounts, volume of account, doubts about the correctness of accounts, multiplicity of transactions in account, or specialized nature of business activity of SSE, and interest of the revenue, in the interest of the revenue, AU, that is the assessment unit, may, upon recording the reasons in writing, request NFAC to invoke provisions of 142(2)A for forwarding the case to the jurisdictional principal CCIT, CCIT, PCIT, CIT, or so and so. So there it is being given to understand that some select cases may be converted into in-person hearing cases. That is what I could understand. If you have carefully followed the press statements in the last 6 months, the Honorable Finance Minister conducted meetings in metro cities, including Hyderabad also, which we came to know, and wanted to know whether this faceless assessment scheme is going smoothly and what are the grievances. And there I am given to understand that there is some scope for some in-person cases in very few select cases, that too in a team-based approach, as so the team-based dynamic assessment approach alone will come even in the in-person hearings, that we will know in the probably that is the reason they have brought in a proposal in the revamped 144B provisions. And 144B9, which is creating a lot of trouble, has been dispensed with. And the faceless TP assessments has to wait. In fact, there was a proposal to make the TP proceedings, DRP proceeding, and also the tribunal proceedings faceless. All these three are postponed till 2024 for want of more detailed discussions and consultations. That's a good news. And 148, 148A, 149, 143, 143B. You know, all the search assessments hitherto will happen only under 147, 148 from 1/4/2021. That is one thing. And the new reassessment regime has started last year itself with new revamped 148, 148A is a new provision, which provision mandates the assessing officer to conduct inquiry and get convinced that it is a fit case for issuance of reassessment notice, which is not required in cases of search and survey. That is different. So that 148A, all this new procedure has come in place. We have to talk about the recent developments before the courts of law, where I'm talking about the Rajasthan High Court, Delhi High Court, and Calcutta High Court is in the context of reassessments. See, many notices were issued on the basis of Taxation Laws Amendment, TOLA, Taxation Laws Amendment Act, Ordinance in 2020, on the basis of which they were trying to issue notices post 1/4/2021 on the basis of the old provisions of 148, 147, which all the courts have unanimously given judgment, except Chhattisgarh or Jharkhand High Court, I don't remember. They have upheld the revenue approach, but by and large, that approach has been found fault, stating that if you want to reopen the assessment, you should do only as per the procedure prescribed under the new law, which is effective from 1/4/2021. You can't go back, issue notices to do under the old provisions. Everyone was expecting that there would be some tinkering to validate such proceedings, but nothing has been done, thank God. And only the existing new scheme provisions which were brought in last year have been fine-tuned to provide more flexibility to the tax officer to carry out the reassessment proceedings. So that is where they have the new proceedings mandate approval of the higher authority time and again at various instances. But if at all the higher authority's approval is taken at the inception level, the subsequent higher authority approvals are not required and dispensed with. And that is what is one broad change. And reference to 3 years of the preceding assessment year is also omitted. And no orders shall be passed by any officer below the rank of JCIT unless such assessments of AC/DC are monitored by additional CIT or joint commissioner. That is anyhow there in most of the cases it is there, I am not sure, but in such cases it is always there. But in reassessments also now it has to be monitored. That is what has been brought in, except that there is no big change here. But definitely this reassessment regime is for 10 years. We were all thanking God that 6-year regime has gone and 3-year regime has come. That 3-year is very impractical because any undisclosed income of 50 lakh or more, it would be 10-year. These days 50 lakhs is nothing. So it would be mostly 10-year reassessments. And all reassessments are also to be faceless. That is has been clarified. Reassessments are going to be faceless, and 144 assessment, that is expert assessments, are going to be faceless, and even of course appeals are already faceless, as we know. Litigation management, repetitive appeals are not going to be filed. 158 AA, which was already in the statute book, has been repealed, and 158 AB has come in place. And now if a particular question of law has been ruled in favor of the SSE by a jurisdictional high court or a tribunal or jurisdictional high court, then you cannot take another case of similar nature with similar issue for filing before the same high court till that is disposed of. This is where they are going to bring in a concept called acceptance from the SSE also, stating that if at all this ruling goes in favor of the revenue at a later point of time, then revenue must be entitled to file the appeal in this case. For the present, they will not file an appeal to reduce litigation and avoid repetitive appeals on the same issue. Same is the case at the Supreme Court level also. This is a welcome proposition which has come into the statute book from 22-23 assessment year, that is retrospectively from this year itself. Business reorganization, successor entity, whatever notices that are issued, whatever proceedings that are initiated in the name of predecessor entity are as good as initiated against the successor. This is to undo the court proceedings happened in the recent past in the context of NCLT proceedings, where it was held by the courts that notices issued in the hands of predecessor is no more valid because predecessor is no more existing. But be that as it may, now the law entitles and validates such notices as being issued in the name of the successor. That is one thing. And the successor is facilitated to modify the tax return on the basis of the period that has been taken back by the honorable court when these proceedings have been validated. As you know, the predecessor company is taken over by the successor company, and the competent authority would say this takeover is effective from so and so date of the past. They go back 1 year, 6 months, 10 months. So for those back period, that is the past period also, now this successor is entitled to modify the tax return in his name and file. And these case law are overruled and confirmed in the context of this. And TDS on sale of immovable property 194 IA, we all know that 1% has to be deducted by the buyer if the immovable property value other than agricultural land is more than 50 lakh. All through we have been following what is recorded in the sale deed. Now the concept, what is there in 50C has been brought in here to make it consistent. And you will have to see what is the guideline valuation, that is the stamp duty valuation, or the actual amount recorded in the sale deed, whichever is higher, you have to consider that amount and carry out the 1% deduction. And 194R is a corresponding provision with respect to 37 explanation 3, which is brought in with respect to any benefit being passed on. Therein, some 194, if the benefit is more than 20,000, that TDS has to be done. And then 239A, this is the last slide, if I am not wrong. There's two more slides are there. And 239A is again a suppose I'm a resident, I'm making a payment to a non-resident, and the non-resident insisted that they should receive a fixed amount, and I pay $10,000, and the tax on that, I take care as an Indian resident as a payer of the amount that is grossed up. And subsequently, I come to know that this particular transaction is an exempt transaction as per the provisions of DTAA or as per the latest court decisions or so. Then this payer is entitled to come under section 239A and follow the prescribed procedure and approach the assessing officer for refund of that withholding tax which is carried out under 195. This procedure was not there earlier. The SSC, I mean the payer has to go to Commissioner Appeals and then get an appellate order after paying the taxes and all that. Now it is not the case. This will get confined to 195A cases, and then you can approach the assessing officer for refund. And dispute resolution committee is already brought in. I'm not going to spend time on this. There is a procedural amendment to this. And then TPO's order are going to be brought under the revisional jurisdiction under section 263, not under the regular PCIT, but the CIT, international tax or transfer pricing, IT and TP. We have a CIT in Hyderabad. He is the one who is competent to carry out the revisional jurisdiction, that is the 263 proceedings of the TP orders. Accordingly, timelines have been modified in 153 and all that. And then Commissioner Appeals is entitled and empowered to levy these penalties 271 AAB, AAC, and AAD to improve the deterrence. And then the last proposal this I'm discussing is the 285B to extend the reporting requirements of Form 52A to the persons engaged in specified activities such as event management, documentary production, and production of programs for telecasting on television or over the platforms or any other similar platform, sports event management, or other performing art or any other activity as the central government may notify. Originally, this was confined to cinematographic producers who have to give the statement, but this scope is now widened on account of various media now which is in existence. That is the reason this has been broadened, which needs to be taken care. So friends, this is what I thought I would take you through in this 2 hours time. And I'm very thankful for the Visakhapatnam branch for giving me this excellent opportunity of learning and relearning the provisions of the tax law. And we can go ahead if there are any questions, Chalanga.
Thank you, Prasad Garu. It's a very exhaustive and excellent presentation. For about 2 hours, 80 changes discussed in 59 slides under 29 headings. It's really good job, sir. There are now we have in chat box about 3 questions. And the 15 minutes after these 3 questions, if at all, if somebody virtually wants to ask, we want to provide them the time with your permission. Okay. The first question comes from Kamsastri Garu regarding cess.
Regarding
cess.
Okay.
Kamsastri Garu, you like to directly ask the question by yourself, or you want me to go?
The issue is, Mr. Prasad.
Yes.
When the 40A clause 2 was introduced, initially in the bill, the words used were cess and tax. Subsequently, when the act was passed, the word cess was removed.
Correct.
And only tax was included therein.
But surcharge is also there.
Surcharge is there.
Correct.
Cess, tax and surcharge.
Correct. Correct.
So the word cess definitely means something otherwise other than surcharge.
Correct.
That is what the intention of the legislature is.
Okay.
Okay. Now, the Bombay High Court and the Rajasthan High Court have held that
yes,
cess is not covered by 40A clause 2.
Correct.
Now the thinking is following Mr. Srinivasan's case,
Hmm.
tax includes cess.
Correct.
And therefore, even in the memorandum explaining the final bill also, the Srinivasan's case has been elaborately considered and explained.
Correct.
So, can the Supreme Court decision overrule the intention of the Parliament by avoiding the word cess? That is a area wherein there is some controversy still prevailing, if I am not wrong.
Okay. No, I do agree. There can be definitely divided views. There's no doubt. As you rightly say, the word cess is not there in 48(2).
No, originally it was there. In the finance bill it
But
was
in the
there.
Act, it is not there.
The Act it was not there.
It is not there. Even
Means
now,
the Parliament in its discretion has removed the word cess.
yes, yes. 48(2).
Yeah.
Any sum paid, I just opened the Act, any sum paid on account of any rate tax levied on the profits or gains so and so, for removal of debt, clarified, then incurred shall be deemed to always any eligible to tax rate so and so. And tax means you have to go to the definition under 2.
There, anyhow, it is not included.
It is not included. Okay. So
See,
now
the definition of tax is not there.
okay. Definition of
Only
tax.
directly in section 48(2).
48(2).
The definition of tax certainly even say it is certainly not covered. Cess is not covered.
Correct.
237 capital A.
Yes, yes. So
237
here,
capital A does not cover cess.
yes, here the explanation given in the memorandum also has some weightage according to me. What I mean to say, this cess, what was envisaged under the tax law, is a cess being levied by the central government and not the state government. The circular which was taken recourse to by the Honorable Court referred that circular, which circular is talking about the cess being administered by the state governments. That circular was released way back in 67. So
Yes,
this position
48(2) was also introduced way back, no?
No, that is correct. But in Srinivasan's case, there is a clear observation that cess what is envisaged has to be taken as an additional surcharge. And there they have combined and grouped the cess as a surcharge. When once it gets grouped into surcharge, automatically surcharge gets covered as a tax. That is the ultimate reasoning now given. And thereby they said the judgments are not in line with the intention of the law. The intention of the law was well protected by the judgment of the Supreme Court.
Then we can take advantage of this in the DTA context, wherein the DTA provides 10% and the Income Tax Act also provides 10%. Then we can avoid both surcharge and education cess.
Then that for
because their taxes covered.
No, for that we have already got the judgments, no? That
Yeah.
only the tax, the rate of the DTA has to be followed. It is all inclusive.
Correct, sir. Whether the rate includes see there, the rate includes surcharge, but the contention of the department is it does not include education cess. Why? Because cess is different. So now we can take advantage of this.
Yes. There they cannot
certainly take an advantage there.
Yes.
What is a loss here is again there.
Yes. You cannot blow hot and cold.
I am only trying to create a controversy for discussion's sake. I am not saying that I am right.
No. I fully understand. Unless we discuss with the two views, definitely there is no discussion. See,
and one more thing with respect to 144 capital B is, if I have not read the entire finance bill, but I have read this, they have removed clause small q in explanation. Clause small q deals with originator. Originator shall have the same meaning as assigned to it in clause ZA of subsection 1 of section 2 of the Information Technology Act.
No, which provision you are talking?
144 capital B explanation.
That is a faceless assessment.
Faceless assessment. Okay. They have removed the word originator as defined in the Information Technology Act.
Okay.
The meaning of the word originator as per the Information Technology Act is, if any notice is placed in the computer resource,
Yes.
which is outside the control of the originator, then the notice is deemed to have been served. Here is a case under ITBA portal, notices are being placed. And 144B ITBA portal is under the control of the department.
Correct.
Naturally, then, once it is placed on the ITBA portal, it cannot be deemed to be a service unless and until a real-time alert is given either on your mobile app or on the registered email ID of the user.
Okay. Very good. Very good
But
point.
this queue has been removed. This is there with the faceless assessment, faceless appeals. Yes, notice must be served by a real-time alert. But with faceless assessment, if this queue is removed and if it is placed on the ITBA portal without real-time alert, does it mean to say that every SSC has got to look into his ITBA portal every day to see whether there is a notice or not?
Correct.
Without a real-time alert on my mobile app, on my mobile number, or on the registered email ID.
Correct.
You may expect me realistically to view my mobile or the email on a regular basis, but not my ITBA account on a regular basis or on a daily basis.
Correct.
When
That
the
is a
queue
very
is
valid
removed, which is more dangerous than removing 9, subsection 9. Why? Because subsection 9 always you can argue on principles of natural justice, irrespective of whether this 9 is there or not.
Subsection 9 is only for their benefit. They have removed it. It is not.
They have removed it, but still your argument can be there on principles of natural justice. That is a recognized principle by the Supreme Court. But this queue is being removed.
This is all the more dangerous.
This is because I happen to have, you are the third person I am listening to on the budget after Chaitanya and Pinakin Desai. So I am having the benefit of those two people's presentation also.
Very good.
That is why this queue is more dangerous.
Yes.
Removal of this queue is more dangerous. That's what my opinion is. I'm only trying to share my view, that's all.
And is it highlighted by Chaitanya?
No, it's being highlighted by me. There also only they talked about subsection 9.
Okay. Then
they have talked about only subsection 9.
Then the whole credit goes to you. This is all the more dangerous. What you are highlighting is a real miss. Even I did not observe that. It's a real miss. And it's all the more dangerous. We have to take care.
All the more dangerous, sir. Because in faithful judgment, the provision is very clear. The notice is deemed to be served only when a real-time alert is given. Faithless appeal, but not faithless assessments.
Correct. That is true.
Thank you, Kamsastrigar, for the contribution of your thoughts. And we have another question from Satyaprakash. Gain from virtual digital asset will be computed under the head income from other source or under separate column within income from other source.
Nobody knows.
No, separate source, no, because that cannot be equated with the income from other sources. You are not allowed to take gains from the then and adjust it here. No, this is a watertight compartment by itself. 115 BBH is a watertight compartment. And written, they will provide a separate menu for that.
Okay, and the question is that in the budget 2022, it was held that the cess is not an allowable expenditure with retrospective effect.
Yes.
If returns are already filed claiming such cess for assessment year 2021, maybe for earlier years also, what to do? Can you kindly suggest what will be the possible course of action to be taken in this regard? Can the revised returns be filed for the assessment year 21-22, or is there any chance that those returns will get processed as few of the returns for assessment year 2021 were already processed?
Man, that means what he means to say is cess is claimed as an expenditure in working out the profit and all that. then it is always advisable on the basis, once this becomes a finance act, then he has to definitely revise if at all the revision time is there.
But sir, if you are saying that revision time is not there in such cases,
In such cases, it is not there. Then probably I don't know, because it is whether you can file a letter offering the difference tax so that there is no disallowance or any other penal consequences. We will have to that can be because a letter in many instances when you cross the revision time, it is always letter was I mean filed, and it was it has helped both ways for revenue and I mean the SSC also. One can offer because it's a payment of tax, department would welcome it.
Of course, it will save you from the penal consequences.
Pardon?
It will save you from your penal consequences.
It is-
Penalty
will
consequences you are saved from.
we are saved from the penal consequences. That's what Mr. Kamsastri is.
Correct.
See, that letter will help you in the penalty proceeding.
And that's the reason I'm suggesting that. That's the reason I'm suggesting, because though you have crossed the revised return time, you can still go through this letter, so that they will definitely save him from the penal consequences, no doubt.
So with this, we have exhausted the questions in chat box, and members in the session, if they want to ask directly or they want to contribute anything, they can unmute themselves and participate.
I think they have understood all the provisions thoroughly.
No, sir, it has been explained very well by you. So now they start thinking on the provisions, and they will be, that mind-boggling sessions will start. Thank you, sir. And in fact, members, the presentation has been made available to us.
Yes.
A small question.
Please go ahead, sir. Please go ahead.
This 139.8, that the updated return they used, why they updated instead of the return? Updated return, why they used that word updated return?
No, update. That means you are updating your income details in the correct manner.
If I don't file the original return, can I file the, that is updated, it will come as updated, or filed return, or again I have to file it updated?
No, even though you have filed, only when you have filed original return, missing out certain things, you are provided this opportunity, no? By any
even if I don't,
chance,
even if I don't file also, I can file the return.
Even though you have not filed original return, belated return also, you can file it.
Updated word they use, that's why that you be this thing. That's
No, let it be anything. The essence, let us take the essence. Updated also gives the correct meaning only. Updated means it is going to capture and compute all sources of income, all items of income without missing.
And in some version, some note, it has come as updated, means only revise we can file the return. Like that, it is nothing like that.
No, because it has been explained in the provision. No, we have to go with the explanation what is provided in the provisions.
Okay, sir. Thank you, sir. Thank you.
Members, your attention to Vice Chairman Sri Vasudev Murthy garu.
Sir, members, any more questions are there? You can unmute and ask the questions. Kamsastri has contributed a lot with full discussion and certain.
No. Why not the management committee and vice chairman contribute something by way of questions, sir? The management committee is not precluded. The management committee is not precluded from raising questions. You can also raise questions. Not only this, you are also a participant in one way.
Yes, sir. Yes, sir.
You are also an organizer and also a participant. So
yes,
you can
sir,
also contribute.
we are participants. So I think because you have elaborated all the provisions and covered, sir, I think members are not asking. Chalangar, shall I proceed, voter?
Please, sir. Session is
Chairman of
yours.
the Southern Branch of SIS of ICA, in absentia. Chairman of Visakha Tax Bar Association, Sri CAAV Chalangaru, and today's resource person, CA PVSS Prasad of Hyderabad, MC members, past chairman, senior professionals, and my dear colleagues, a good evening to all of you.
Sir,
At the outset, we are
Sir.
thankful.
sir, this is Prashant, secretary. I'm in the.
Yes,
session, sir.
I know it.
Yeah,
I
yeah. Okay, sir. Okay, go ahead.
At the outset, we are grateful to Sri PVSS Prasad Garu, today's resource persons, who has allocated the time to us today, in spite of his busy schedule. Sir, you have elaborated and deliberated various important amendments in the direct tax proposals in the recent union budgets 22-22 on 1/2/22 introduced by our Parliament. On behalf of the Visakhapatnam branch of SISF ICA and Visakha Tax Bar Association, we extend heartfelt thanks from bottom of our heart for your illustrious deliberations on the amendments as well as the new sections incorporated in the direct tax proposals. We also thank Sri CAAV Chalangaru, Chairman of Visakha Tax Bar Association, for his opening remarks and support extended in organizing this webinar also. We are also thankful to the past chairman, MC members of ICA, members of Tax Bar Association, and all the members who has participated here and deliberated the raised by the issues like Kamsas Garu and RVL Garu, etc. And thank you one and all, and made this session a grand success. Thank you one and all.
Thank you very
sir.
much.
Meeting is concluded. Members, please stay safe.
So,
Prasad garu, good night.
thank you very much, Chalam Garu. Thank you.
Our pleasure, sir.
Good night.
Our pleasure.
Good night.
Kam Shastri Garu, thank you
Good
very
night.
much.
Good night, sir.
Good night. Good night. So I will leave the meeting. Thank you.
I think Kamsas
Yes.
left.
No, sir. I'm here.
Prasad garu,
very
మీరు పర్సనల్ గా మా బ్రాంచ్ ఒకసారి ఇన్ పర్సన్
Right.
రావాలి సార్.
Thank you, one and all. Stay safe.
This is
and
our
stay
request, sir.
Sir, Prasad sir, this is really a wonderful session, sir. And it's cleared more doubts of the minds of the members, sir. Really, it was wonderful session.
Thank you.
Thank you very much, sir.
Thank you very much. Thank you very much. So I'll take leave. Thank you very much.
Thank you,
Chalam
sir.
Garu.
Thank you, sir.
Thank you. Kam Shastri Garu, right.
Yeah, good night.
Good night.